somebody's been throwing rocks at economics for a long, long time, as for the part of you are aware, it's lovely to be getting an audience that's considering maybe we should move on from where economics got itself to in the last 40 or so years. And as you mentioned, I've got the one thing I'm actually pleased as well, that hopefully by tomorrow there'll be an e-book version, a Kindle version of the book, if anybody wants to get hold of it, because there were holds up with Z, who are the publishers, and they've now finally let me put a version up myself, which I aim to have that by before Monday. So that's the book. That'll be the end of any promotions. Let's take a look at economics instead. And one thing which is happening, a lot of neoclassical economists are coming out and saying, well, we have models for the good times, and they work really well. It's not our fault we didn't have a model for the bad times. Pretty much paraphrasing, in fact, even praising Bernanke, where that's the excuse being used now for not seeing the crisis coming, and the model played a necessary role in getting us the good times. That's nothing like what was being said before the crisis. If you take a look at the literature and how neoclassical economists were talking about macroeconomics at the time, it was statements like this from Lucas that I think really set the tone. There was a sense of triumphalism, saying macroeconomics was born in the 1940s. I would have thought, I'd say the 1930s, but still, 1940s, referred to the body of knowledge we hope would prevent another crisis. And he's saying, his lecture, and this is his presidential lecture to the American Economic Association in 2003, 2004, saying, we've succeeded. The central problem of preventing depressions has been solved for many years, decades. But that sense of triumphalism was really the literature prior to the crisis striking. And a similar one from Greenspan, saying that he saw from 1995 onwards, which I would actually date as the beginning of the crisis, in the sense of the processes setting in train were well and truly evident then, moving smoothly from one state of equilibrium to another, invisible hand, and believing that you get a growing, and the most important word in that final statement, a growing and stable economy. That's the vision that was had, as you can see, with Greenspan up to 2007. And in the serious academic literature as well, Olivia Blanchard, I think, probably now wins the award for the world's worst timed academic paper. Only Irving Fisher could compete with the statement to bankers back in the middle of the stock market crash, when he said that, talking about the dominance of the new Keynesian school in the battle between new Keynesian and new classical DSGE modelling, saying that facts have driven us towards the new Keynesian being the superior methodology. And he's saying not everything is fine, none of it is deadly, however, the state of macro is good. Now the date of that being published in a journal was 2009, but the date he would have uploaded that onto the, I've forgotten the name of the main server we use for academic papers, but was August 13, 2008. The crisis is now normally dated. It was started on August 7, 2007. So a year and a few days after the crisis, saying it's all good. Well, obviously he changed his mind afterwards. But largely his argument, and this is quite common in the literature at the moment too from the neoclassical point of view, that it's an adverse shock nobody could possibly have predicted. And this statement here really says that it's from the financial sector, but it could have been a pandemic on tourism or a major terrorist attack. Well, I think most people might be willing to regard a pandemic as an exogenous shock, but again, why should we regard the finance sector as exogenous to the economy? That's a bit harder to justify to non-neoclassical economists. And when modelling is attempted, this is a paper from Ireland about trying to model the crisis using a new Keynesian model, he starts by saying there's a series of adverse shocks, much the same as any other recession, but then they turn bigger and nastier. Therefore, it's the size and scale of variable shocks that explain the crisis, not explaining why these shocks, which are supposed to be exogenous with a mean of zero, grow in size and remain negative. That's still a mystery. And I don't think it can in any sense describe that as scientific behaviour. And I don't know how many of you are aware that Robert Solow has been waging a one-man war against DSGE modelling for some time. And writing in 2003, he argued that you could potentially claim that the pathological behaviour of the economy that isn't possible within the new classical DSGE model, and is barely possible within new Keynesian models, you could argue that due to exogenous shocks. And putting it quite simply and eloquently, why should reasonable people accept this? Why should anybody accept that as an explanation for this crisis? So I think we need an alternative response. I spent a lot of time in debunking economics, going through why I think DSG modelling was so bad, never ever capable of modelling an economy in any sense. but I'll skip over that for tonight and mainly talk about how to bring about an alternative credit-based macroeconomics. And an essential part of it is arguing why the aggregate level of debt matters. The one point of resistance I find when talking to economists is they're willing to argue that the distribution of debt matters, but they can't see how the aggregate level matters. And I'm arguing emphatically that it does. So starting from a very simple starting point, everybody has two potential sources of spending in a credit-based economy. You can spend from your income, or you can spend by increasing your debt level. Those are two, for both individuals and corporations, those are the two means we have, as well as government spending being a potential third source. And I'm looking just now at a strictly private economy. So neoclassical theory will count the first but ignore the second. And here are a couple of recent papers, quoting from Krugman now, his paper with Exhaustion, building a new Keynesian model of the crisis, where he argues initially that you don't need to look at the aggregate level of debt, only the distribution can matter. And his proposition is then put into effect with a two-agent model where impatient agents borrow actually units of a consumer good, not money, from patient agents. And that vision in a graphical sense is a bit like this. We envisage, or neoclassical theory envisages, banking as being an intermediary between patient people who save money and impatient people who need to borrow it. And what actually happens is simply a transfer of spending power from one to the other, which means that the patient's agent's spending power diminishes, the impatient one goes up. Unless there's a major difference in propensities to consume or spend out of cash, there's no change in aggregate demand. So you can ignore it at the macro level. And of course banks, which are just being intermediaries in this process, are also unimportant. So again, the macro modelling leaves out both money, debt and banking. Now, from the endogenous money perspective, there's a very, very different argument. That is that it is not a case of transferring spending power from a saver to a borrower and therefore having no impact on aggregate demand, but creation of money and spending power out of nothing. Now often that's a sort of phrase you'll see associated with the crank analysis of monetary system. There are plenty of cranks out there with their own views about how the money system works and how to modify it. This particular crank is called Joseph Schumpeter. Okay? Writing back and discussing in the theory of economic development about how does one fund investment, he said, well, it's feasible to argue that you can save money and that can finance some investment. But he said, in fact, it's, as you can see the way he expresses it, not obviously absurd. There is some potential for that, but he says truly the major way that money is gained for investment is the creation of purchasing power by the banks. And he literally uses that phrase, it's not a case of transforming purchasing power which already exists, so the saver to borrower argument, but the creation of new purchasing power out of nothing. And that then enables investment to take place without meaning anybody's spending has to be diminished in the process. So that is therefore why the aggregate level of debt matters. And there's plenty of empirical research to report it, as well as a few references. I highly recommend people taking a look at it if you're not familiar with the endogenous money approach. Alan Holmes writing a paper trying to stop the experiment in monetarism, arguing it won't work from an empirical point of view and from a point of view of somebody who is intimately involved with the monetary system. All people, Goodwin and Prescott, who of course gave us the real business cycle models to begin with, conclude a very good empirical paper with the proposition that bringing credit and debt into macroeconomics in a way that accounts for not just financial variables changing, but real ones as well, is an important open question in economics, one they did not address. But they strongly support that we should be doing that in this particular paper, empirical paper. And then the person who really was the father of thinking about endogenous money, Basil Moore, the post-Keynesian economist Basil Moore, in a series of papers, largely empirical in nature, arguing that the money supply is endogenous and we need to recreate macroeconomics around the view of endogenous money. So those are certainly sort of if you haven't read them, I highly recommend reading those papers. So what I've been trying to do, coming from that background and working in Minsky's hypothesis as well, is develop a model that can generate a Great Depression as an outcome. The pathologies that aren't possible in the neoclassical school or indeed in ISLM. And Minsky gave the best possible arguments why we should do this by saying that the real question for economics is, can a Great Depression happen again? And if one can happen, why hadn't it happened by the time he wrote this paper back in 1982? And he said, to answer that question, we have to have a model which can actually generate a Great Depression as one of its possible outcomes. Is that fundamentally what he's saying, unless you have a model which can generate a state like that, then you don't have a model of capitalism. And in that case, he also rules out the neoclassical model, including ISLM, because he said you can't get instability out of the model, and when you construct it, you leave out capital assets, financial arrangements on banking and credit, liabilities and uncertainty. And so with those things not included in your model, you're not going to generate experience like the Great Depression. So I've got to move away from the neoclassical synthesis. Now, Minsky never developed a workable mathematical model. He attempted one in his PhD, and he based that model on the Higgs-Hansen-Samuelson second-order difference equation model, where he made the accelerator component a financial accelerator, which, as debt levels rose through Krukowski's principle of increasing risk, would lead to that parameter varying and then giving you cycles. I argued a long time ago that the model itself is mathematically correct and economically nonsense. Not his model, but Hicks's model. It actually involves a fallacy, economic fallacy, as a basis of deriving that model. So it's no wonder that Minsky got nowhere with it. He basically abandoned the mathematical route, even though he was trained in mathematics as well as economics. But his verbal model came together probably around the late 60s, early 70s, once he had been influenced not just by Fisher, Hicks, Schumpeter, who was his PhD supervisor, and who else was the other major influence? I've left one out, Koleski. And he finally read Keynes in he read the General Theory of Employment in the 1937 paper. And then having read that, he basically said he couldn't believe that anybody could regard ISLM as a summary of Keynes, that was how Keynes summarised himself. And then he finally wrote his book John Maynard Keynes in 1975, which brought the whole thesis together. So his basic verbal argument starts with an economy in historical time, and of course both history and time are left out of most economic models. And he said if you're in historical time, there's been some debt-induced recession in the recent past. So the one I'd suggest you have in your mind is the 1990s recession. Now because of that crisis, both banks and firms are conservative about the amount of debt they'll take on. And this is not asymmetric information. Asymmetry plays a bit of a role in Minsky's thinking, but fairly minor. What he's really talking about here is shared expectations given an uncertain future. So both banks and firms have similar expectations about the future. Given the fact that there's been a very severe crisis, they both have dampened expectations. So the only ones that will be put forward, and the only projects considered for debt funding, would be conservatively estimated projects. Because the economy's recovered, most of those projects succeed. And therefore firms start to revise their risk premiums, increasing the ratio of debt they're willing to consider and valuing assets more highly. And Minsky has a classic phrase, stability in a capitalist economy with sophisticated financial institutions and an uncertain future is destabilising. So stability, a period of tranquil growth in other words, causes expectations to rise. So the equilibrium itself is a repeller. Essentially, you can't model it as an attractor in that sense. Now for a while you get self-fulfilling expectations coming out of this because having had a decline in risk aversion and there's more investment taking place, the economy grows more rapidly, which partly finances those other investments. You ultimately get to the stage of what Minsky calls the euphoric economy. And that's where really expectations of both capitalists and bankers is characterised by euphoria rather than reason. That process of rising expectations has gone on for some substantial time. And you can speculate on assets at the time and make a profit because asset prices are rising. The money supply is expanding endogenously. Again, this argument the money supply will expand given the demands upon it from the commercial sector. And then it enables riskier investments still and more asset speculation, and it helps the emergence of what Minsky calls Ponzi financiers. Now one amusing thing is that I've realised I've given presentations based on this model going back 15 years. And 15 years ago I had to explain who Charles Ponzi was. 15 months ago I almost had to. I don't do anymore. Even in lay audiences they all know who Charles Ponzi is. So Minsky defines a Ponzi financier as somebody whose cash flow is less than the debt servicing costs. So the only way they remain solvent is by borrowing more money, because they're losing money on a day-to-day basis. They are losing money, and the way they profit is by selling assets on a rising market. So they both push up the demand for money, and they also help drive asset prices higher by borrowing that money. And they're really insensitive to the rate of interest. You can't control them. by putting up the rate of interest, because they're expecting asset price appreciation 2 and 3 times as high as you might set the interest rate to, and quite literally 2 and 3 times as high, and at the same time they can't afford not to borrow. If they stop borrowing, they're bankrupt. Okay? They are bankrupt all the time, fundamentally. Their insolvency only becomes visible when the crisis hits. So you can't stop them borrowing money. The usual prevention mechanisms you can think of using won't work. What you then get is rising debt levels compared to GDP, and a lot of that debt's been taken on for unproductive reasons, so there's more loss-making enterprises out there. Rising rates as well, commercial level, with even without the Reserve Bank jumping in. And that makes some conservatively estimated projects actually speculative in nature, potentially. One of many triggers that can mean non-Ponzi investors decide to liquidate assets to come out ahead. They do so, and they flood the asset market. It's far narrower than people think it is. So that rising trend of asset prices falters, and as soon as that happens, the Ponzis are the first ones to go bankrupt, because they can't sell the assets for a profit anymore, and they can't roll over their debt anymore if they have to roll it over. My favourite Ponzi in that case, illustrating just how fragile they are, was a guy called Connell. Now, in Western Australia, you might know who I'm talking about. The Premier of Western Australia once remarked that he'd hate to stand between Connell and a bucket of money. Laurie was known as last resort Laurie. He'd lend to finance any form of speculation. If you couldn't get money from anybody else, you'd get it from Laurie. He went bankrupt the day after the 87 stock market crash. Was then rescued by the Ponzi merchants and then collapsed later, and spent his retirement days painting on Her Majesty's service. Okay. So asset prices collapse, debt to equity ratios rise at this stage because the equity prices collapse. The money supply expansion stops and goes into reverse, investment evaporates, growth slows down, you're back where you started again. So it's a classic cyclical model. Now, you're only in one sense back where you are, because the process will repeat when debt levels fall somewhat, but they will start from a high level of debt to GDP. There's a tendency for this level to ratchet up over time, and a simple way of illustrating it is that people borrow money during a boom and have to repay it during a slump. So they have less cash flows than they expect to have during the slump than they had during the boom itself, and the reversal of expectations occurs before you get back to the previous level of debt. And the process goes on for long enough, you can get a level of debt that overwhelms the economy. So it's an explanation both for cycles, but also a final breakdown. Now that's the verbal model. I began modelling this in my PhD thesis back in the late 80s, and the basis of the model was Richard Goodwin's cyclical growth model from 1967. Is anybody here familiar with that model? A few, good. Recommend it. Goodwin writes very poorly, unfortunately. I think it's a brilliant mathematical modeler, but a very complicated writer. John Blatt did a far better job of summarising a book called Dynamic Economic Systems that I highly recommend to anybody who hasn't read it. Much, much clearer explanation of Goodwin's model and many other things in economics as well. So you can put the model clearly quite simply by arguing that the level of capital determines output by an accelerator relationship. And here I'm using some simulation software to illustrate the cyclical nature of the model. Income then determines employment given labour productivity. That then determines the level of employment given population. That then determines the rate of change of wages through a Phillips curve relationship. Integrate the rate of change of wages, you have the wage level. Multiply that by the level of employment, you've got the total wage bill. Subtract that from output. In this simple, you therefore determine profit, but in this simple model, Goodwin argued just had all profits being invested. So the integrate profits, you have the level of capital. So you close the loop of the whole system. And when you simulate that model, you get cyclical behaviour. Speaking in mathematical terms, it has dominant eigenvalues with zero real parts. So you get cyclical behaviour. You don't get equilibrium, nor do you move further away. Now Blatt argued that it'd be a great basis for that model would be a great basis for building a model including finance, which is the lead I took to get my PhD underway. And the essential element of bringing Minsky into that model, those two equations, by the way, the rate of change of employment and the rate of change of worker share of output. That's the two-state model. Now you've got to bring in debt to bring Minsky in, and for debt, where capitalists are doing the borrowing, it's essential they want to borrow for investment more than they earn. You want to have the gap between investment and profits. And again, I simply put that into the model initially. I found these papers later. But again, I find a couple of staunchly neoclassical economists who, when they look at empirical work, do very good empirical work. And here's Spamer and French concluding that debt is the residual variable in financing decisions. Investment increases debt and higher earnings tend to reduce debt, stating that as a differential equation, saying the rate of change of debt is investment minus profits, which is exactly what I introduced into Minsky, to bring Minsky in, where I have a non-linear relationship determining the level of investment. So the desire to invest based on the rate of profit exceeds profit when profit is high, is less than profit when profit is low. And that then generates a three-dimensional model where you have three system states: wages, share of output, the employment rate, and the debt to output ratio. And that now takes us from a two-dimensional system to a three-dimensional system, non-linear, which can generate chaos. And it does that, and it has locally stable equilibrium. So if you start close to the equilibrium, you'll converge. You start further away, you diverge. So it's actually following what's known as the inverse tangent route to chaos. Now, when I simulate that, what you get, of course, is sensitive dependence upon initial conditions. So if you start close to equilibrium, you get convergence. But you start far from equilibrium, you get a debt-induced recession. So that's showing employment and the wages share of output in both situations, one with obvious equilibrium convergence going on, the other with a massive divergence and finally a breakdown. What's actually driving that is the level of debt, the debt to GDP ratio. So the red line is the equilibrium situation where bankers actually accumulate, firms accumulate negative debt, therefore like a positive bank balance. The blue line is clearly a case where the debt overwhelms the system, you get a total breakdown. That's what, that attitude is what gave me the perspective to say we could be going into a huge financial crisis. I extended the model to include government as a stabiliser, but I won't go into those details today. What I'm currently trying to do is convert this model, which has implicit money, and the debt is in the system, but I don't actually have money there. Okay, trying to convert it so I do explicitly bring money in. And to do that, I've taken the growth cycle model, Minsky's thesis, and I've added in the work that comes out of a European school who call themselves circuit theorists, people like Graziani, Bellafiore, and so on. Graziani is the most important. And I'm calling it monetary circuit theory. And Graziani gave the insight which really set me off on this analysis, and that is that in looking at a monetary system, he said, we tend to think about capitalism as two people exchanging two commodities in a barter relationship. And he said, that's not a monetary system. In a monetary system, you have three agents: a buyer, a seller, and a bank. So you have to include the bank as an integral part of your model, and you must separate the banking sector from the firm sector. They've got fundamentally different roles. So I've worked out a way of putting that into a mathematical model using double entry bookkeeping. So if you look at the process that actually goes on in endogenous creation of money, it involves an entrepreneur approaching a bank, preferably an entrepreneur rather than a Ponzi merchant, but of course we'll let the latter take over in the last 20 years. And the bank then gives a loan and creates a deposit simultaneously. So it's not the time-lagged money multiplier way in which money is created. Instantly creating the deposit creates the loan as well. Not a case of anybody having to lose savings to have that created. And Alan Holmes, who was at the time was the senior vice president of the New York Fed, arguing against the monetarist experiment before it started, put it succinctly the same way. In the real world, banks extend credit, creating deposits in the process, and look for reserves later. That's the actual process of money creation. And what that means, of course, is that new loan puts new spending power that's additional to Volrar's law into circulation. So to model that, I found that the way this approach came about was I used to present models which were differential equation models to post-Keynesian economists. And I got what my friend of mine called the Migo effect. My eyes glaze over. And one of them challenged me and said, you must have made a mistake in double entry bookkeeping to get the results you're getting. And I knew I hadn't made a mistake. So I thought, well, I wonder if I can display it that way. And I've since realised I could actually build the models this way. So an intriguing way it came about. This is modelling, imagine a 19th century free banking system where banks have to lend physical notes of paper out to create a loan. This has a bank lending from its reserves, recording the loan, charging interest on the loan, The firm then pays interest there. The bank records the loan's been paid. The firm then hires workers by paying wages. The workers consume and the bankers consume. The firm repays the loan. The bank records the loan's been paid. And new money creation here enables investment to take place. Putting that into a symbolic processing engine, I can convert that into a system of differential equations. That's actually how it's done. So I'll show you that across in MathCAD, which is the way that the package I first started doing this with. That ridiculously simple program, you can't see it where you're sitting, but it's only about 5 lines of code, takes an input like the matrix. Let's make this view a bit larger so you can see it more easily. So that simple symbolic program there takes those inputs. You saw the A, B, C, Ds and Z's over there beforehand, puts it through that matrix and then derives a system of differential equations from it. So I don't need to check the equations, I know they're right.
So the differential equations are basically the same for the system.
Pardon, sorry?
The differential equations are essentially the same for the system that balances between income and spending.
Yeah.
Lead to changes in the stocks.
Yeah, there's no problem about stocks and flows in this.
What it's doing.
Yeah, it's fundamentally flows on one side, rate of change of stock on the other. If you make a mistake by putting a stock entry into the flow, you see it instantly. The model just goes bang, crashes. So it's virtually impossible to make a stock flow error working in continuous time models like this. And then I go on to simulate the rest of it here. I'll come back to that in a moment. So that's the MathCAD version of it. Now, to link it to the physical model I had beforehand, I've got to bring in, because the Phillips curve is now in monetary terms rather than real. Profit's monetary as well. So a profit is now price times quantity minus wages minus net interest payments. So actually working fully in nominal terms here. And I needed a dynamic price equation. I got a surprise in working this one out, because I started from saying, what would you have if you had a simple constant money stock system in equilibrium? What would be a price relationship you could derive from that? So if you had the output being Q and the labour the only input, so output is labour times labour productivity, and a constant money wage, then you have to say, okay, what's the wage flow from firms in this system? And this expression is the wages flow. That, to break that down into 3 components, the first bit is workers' share of surplus. So there's a surplus generated in production. Part goes to workers, part goes to capitalists. S is the capitalist share, the 1 minus S is what workers get. Tau S is the time lag between starting production, or getting money to start production, and getting the money back from selling the goods. So it's the turnover period in Marx's terms. And FD is the balance in the firm's sector's deposit accounts. So it's the amount of money sitting in the firm's accounts at any particular point in time. So that's the actual flow of money, which is hiring workers. The number of workers that can be hired is that flow divided by the wage rate. So you then divide that by W, and you've now got the number of workers you're going to hire. Now, physical output is going to be the number of workers you've hired times labour productivity. Already got that one expression in there. And I can now say now I've got the number of workers, I've now substituted that above term. And physical demand is going to be the flow of demand through the whole economy, and that works out as being the sum of what workers and capitalists are earning. And that again turns out to be the amount of money in the deposit account of capitalists divided by the turnover period. I'm adding 1 minus S plus S of that fraction. That's what I get. That's total nominal demand on a yearly basis in the model. Put it all together, and physical demand is therefore going to be that level divided by the price level. Now, in equilibrium, I'm going to use it for derivation purposes alone. The flow of supply in physical terms will equal the flow of demand in physical terms. So I equate these. Now I work out what the equilibrium price is, and have this expression. You can instantly see there's quite a bit of cancellation that goes on there. Those cancel, and they cancel, and what you're left with is saying equilibrium price is going to be a markup over the monetary cost of production. It's Schumpeter's pricing equation and Koleski's come out of it, which is ridiculous, because they're not ridiculous. I didn't start from a Koleskian or Schumpeterian point of view. It's just doing monetary modelling, but it derives the same result. Now, therefore you can say price in equilibrium will be a markup on the monetary cost of production. There's your markup, money wage, there's output per unit. But what you're really saying is that prices convert the physical surplus into a monetary one. Really quite simple. And then putting that in a dynamic sense now, having a dynamic equation that's consistent with that, the rate of change of prices is some time lag convergence to that equilibrium value. So that's the rate of change of prices, and 1 over tau p is the time lag in price changes. And if you look at empirical work, that's normally roughly about a year, it appears. So that's how that was all derived. Now, that let me build this strictly monetary model. So I've got the, in addition to what I've shown you there, I've got a nonlinear investment function, capitalists reacting to the rate of profit by investing more when it's high, investing less when it's low. Lending and debt repayment also being nonlinear functions. So if I go back to the MathCAD illustration, I think I've got those up here. So I have the number of years that capitalists wish to take before they repay a debt growing as the rate of profit grows. The higher the rate of profit, the less you want to pay your debt down, because if you pay your debt down, you've got less money to invest. So those sorts of relations are in the model. They're all exponential relations. There's no attempt to impose some dynamic on the system by having a King's equation or anything like that. And I bring in the 3 factors Philip spoke about. He had not just the level of employment, but the rate of change of employment and inflation as things workers responded to in terms of setting wage demands. And what you get out of that is a system with 11 differential equations in it, so it's a bit of a monster. That's the total system there. And this is simulating over in MathCAD. I'll bring up the first part of the simulation. When you run it, this is looking at real output. Something goes wrong at year 55. So let's take a look at what actually happens there. And this is the empirical data now, looking at this smooth data in the American economy from 1980 to 2010, before the government rescues really began. And you can see what they saw as the great moderation with this declining level of inflation and unemployment until the breakdown occurred. And what they ignored was this ratio of aggregate debt to GDP. And I haven't attempted to fit the model yet to this data. It's just been a case of making it work mathematically. I haven't tried to do any estimation as yet. This is one output from the model. So in a stylized way, I've got the same basic dynamics as we saw in the economy. What I've got going on there is infinite collapse, because there's no bankruptcy in this system. You don't have any way of getting rid of the debt. So if you don't pay the debt, it simply continues to compound. Total breakdown. So I think it's one case I'm going to be very strongly in the same camp as the Austrians. We've got to allow people to go bankrupt. And preventing failures causes crises. And this paper's coming out in GBO, I hope sometime early next year. Now, that's a single sectoral model. Obviously, the ambition is to go to multi-sectoral. And it turned out to be, in a weird sort of way, easy to do that by taking the input-output relations in a financial sense. Attempts to get dynamic input-output models with equilibrium pricing have failed, but we don't have equilibrium pricing in the economy. We've got non-equilibrium dynamics going on, and of course the relations between sectors aren't barter. They have to buy the inputs off other sectors. So I input the input-output relations not inside the physical economy, but in the financial sector. So this is the same table that I've shown you for the single sectoral. Now has 4 different sectors divided in 2 to force all transactions to be financial, and a monster set of equations are derived out of that. But it's infinitely scalable. There's no limit to the number of equations you can build out of this system. And what I get out of it...
What are the 4 sectors?
It's notionally speaking a capital goods sector, agriculture, energy and consumer goods. But it can scale to any number of sectors, and we've now developed a Mathematica implementation of this that can handle an arbitrary number of sectors, which I intend linking with a CSIRO project. What I've realised since doing that is that it's better to do this in a multidimensional sense. So rather than adding additional columns to get this huge 2-dimensional table, you make your table 3-dimensional, and each extra slice is a different industry, and then your input-output relations are relations through the slices. So that's what we're working on at the moment. Now, what it generates, and this was a miracle in the sense that it couldn't possibly have happened unless there's something fundamental to what I've generated out of this. Because when I first put the model together, at the behest of the CSIRO, I went into the next room to press the simulate button, convinced I'd come back saying it crashed. Because what were the odds I could put the structure of the model together, but what are the odds I would have chosen a set of parameters that would work? Big fat zero. I walked back in and said, well, that was easy, because this is what came out. This is the rate of profit in the 4 sectors. This is the aggregate rate of rate of growth and the debt to GDP ratio plotted on the other axis. And one thing which Galbraith emphasised in talking about the trade cycle is that it isn't symmetrical. It tends to have a long, slow boom and a sudden, sharp collapse, and he actually described it looking like a sawtooth. All this emanates from the structure of the system. And the fact that the limit cycle came out of it, that's a genuine multi-dimensional limit cycle. This is the financial sector also has its own limit cycle where excess reserves cycle as well. And income distribution is also a series of interlocking limit cycles. I could only have got the parameters right if it's something fundamental about the system that meant it works almost regardless of your input parameters. And we know from the what's called the dual instability hypothesis, by Jorgensen's work decades ago, that if you have an equilibrium system, input-output system, either the price vector or the quantity vector has to be unstable, because the stability of one depends upon the inverse dominant eigenvalue of the other. You therefore have to have instability. That's a real problem with equilibrium pricing, but it's no problem with this equilibrium pricing. It just means you get a limit cycle, which is what turns up there. So I've still got to explore that in great detail, but that certainly was a very good start. Having done all this in Mathematica and MathCAD and similar programs like that, I'm trying now to make this more accessible and also make it easy to use both as a teaching tool at one extreme and a research tool at the other. And one of the great things about being involved with the public is some of the public know a lot more about computer programming than we do. And one correspondent finally wrote the system we call QED that enables this to be done by putting a set of tables like that in. I'll just bring up one of the QED models here. And so it's the same sort of financial table I did there a moment ago. It then generates a flowchart system. This is done as a tribute to Bill Phillips, for those who remember his hydraulic model. And if you simulate it, then you see the flows going through the reservoirs as well as being able to graph the whole thing dynamically. So it's a great teaching tool, not particularly good for research yet because it doesn't enable me to model production in any simple way. It's really designed for financial flows. So that's as far as I've got right now, but I've got a grant from INET just recently, and with that we are developing an implementation of this table. I've got too many of them opening at once, let's see. This is a prototype. I'm trying to find the right window here. Okay. That is an implementation of the same model I've shown you a moment ago. That's a nightmare because the graphic is dreadful. Okay, it's prototype stuff, and some of the flow elements we're defining are far more complicated than they need to be at this very early stage of running the model. But if I run that model, then I get the same dynamics I've shown you a while ago, much faster. But the idea is ultimately to continue working on that until such time as the visual sophistication is similar to a program like this. This is VisSim, for those who haven't seen it, which is a system engineering software package that is great for modelling physical flows. So in terms of modelling the basic Goodwin model, it's brilliant for doing it. Everything is graphical. What you've got is flowcharts here that define various equations, like here's the Phillips curve equation is defined inside here. That is commonly used in engineering. I know some people here use Stellar, which is a very similar program. The difficulty I found in trying to use these software packages to build the financial model was that the interrelations in the financial sector are, in some cases you can have the same term turning up in 4 places. And it's easy to understand that sort of dynamic in a table like this, But when you put that in a flowchart, it's literally incomprehensible. Even if you get it right, and most of the time when I try and make a mistake and I can't debug it, but if you get it right, it doesn't tell you intuitively what's going on, whereas a table like that does. So that making that a widget which is part of a combined tabular and flowchart simulation package is the research project I'm engaged in right now. Let's go back to PowerPoint. So that's it. That's it. Very much.
Right.
Questions? I apologise for my bad hearing in advance, by the way. I'll mishear half what you say, but I'll try.
I want to go back to the last 20, 30 years.
Yeah.
Basically since 1990. We can see various crises of this nature in the world economy. And I want to contrast what happened in Japan with at the beginning of the 1990s with what happened in the United States with the Greenspan put about the year 2000 and what's happening now. So there were three. The first one with Japan was clearly Japan had this kind of financial crisis.
Yep.
And then that was followed by a very long period, which is
Still going
on,
Yeah.
of very high debt and a very low growth in the real economy, if you take it over the long term. Now we can compare that with what happened in the US, and indeed not just in the US, but also in Asian crisis.
Yeah.
The debt had reached a very high level about that time, and yet the central bankers managed to stop it turning into what we would see as a crisis. And surely the same thing is happening now. The central bankers and the governments are doing their very best to stop the crisis by basically supporting the banking system, when otherwise it would have gone down.
I think it is still going down. What they're doing, they're engaged in a futile exercise, but they're slowing the rate at which it falls down. It's one reason I loaded some data before.
So really the question is, can they stop it?
No, I don't think they can. I mean, what they're doing really isn't different to what happened in Japan. I think it's the same thing a bit later. So this will give you an idea of. I don't have Japanese data. It's very Japan does publish debt to GDP data, but they publish the numbers on a different page of a spreadsheet for every year. Most awkward and Japanese text all the way through. It's impossible to pull the data out easily. America's much easier with the flow of funds. And if you go back to what you're talking about, the 1990s, this is the, I think actually make it a bit bigger again so it's easier to read. This is the ratio of both private and public debt to GDP in America from 1920 to now. And it's pretty obvious which one's worse. The Great Depression you can date from the 1930s when it was 175% of GDP. That's pretty much the level it reached after the stock market bubble and burst in the late 80s, and then in the boom that caused real estate and the slump after that. Greenspan's put got us from here up to here. So to compare where we are now versus, and you can already tell there's been nothing like this period of debt reduction in the post-war period. So it is, you can't say they've done the same thing as now. They're trying to, but what they're actually fighting against is the same sort of force that applied over here, where the private sector is reducing debt so rapidly that that's sucking demand out of the economy, and they're attempting to pump the demand up by running deficits or by a QE 2, 3, 4 and 5, but not really being aware of the impact that deleveraging by the private sector is having to counteract what they're trying to do. So just to give you an idea of the level of debt here, this peaked at 301% of GDP up here, and it's since fallen over the last few years to 253%, so virtually a 50% fall in the level of debt. All the politicians are focusing upon this rise in sovereign debt. In America's case, it's gone from, on the flow of funds data, from 54% to 81%. So there's been about a 30% rise in public debt, but a 50% fall in private. Now that fall in private debt is actually reducing aggregate demand.
But this is all gross debt, isn't it?
Yeah.
So what you're really saying is that these people have got into a situation where there are a number of people who are very, very highly leveraged. And there are equally a large number of other people who are sitting around thinking, I own perfectly safe assets in the form of money market mutual funds, bank deposits and things like that.
Yeah.
And the difficulty that's arising, I think, is that the people who've got the bank deposits are not entirely sure that they are safe. So they have to find something to do with them. But I do think that, you know, it is a difficult argument to say that we shouldn't be netting out a lot of these transactions. In some cases, they're going to be the same people.
No, it isn't a case of netting out. This is what we tend to do as economists, because we tend to think in a very static way.
Yeah.
We say asset equals liability, no problem. Okay, what we're not looking at is actually the change in debt through time process.
But I mean, supposing that, what I want to do is first of all find out what you mean about the data. Because if I have a mortgage of £100,000 on my house, and I also happen to have a bank deposit of 100,000, deposit in a money market mutual fund of 100,000, and for various reasons to do with the tax system, I want to keep it that way, and I don't use the deposit to pay down my mortgage. What is that recorded?
Well, you're talking about one individual with both.
Yes.
Okay. They
They
still have to service the debt first. If
But I've got the interest flow of the money market account.
If you've got, but the money market account itself has to be earning interest elsewhere in the economy. You have to have productivity elsewhere
Well,
supporting.
the money market fund might be earning money off somebody else's paying.
Yeah, they're not actually earning out of the physical economy. They're not actually, if they're simply monetising rising asset prices and calling that profit,
Oh, yeah.
it isn't really profit.
No,
And
no,
that's a
I would agree with
Okay.
you about that.
Now, therefore, we never get to these debt levels where you do have resources which are being financed by genuine production being the source of the debt. It's this level of debt, you take a look at the level we're talking about now, has gone from, in the post-war period, it started at 45% of GDP, it's reached 300%.
Yeah, but, okay, supposing it's 300%,
Yeah.
assuming that we have to finance this by paying an interest payment of 3%. What you're saying is the interest payment on all of this debt, I can't quite do the maths in my head, but it should be absorbing most of GDP.
No, it's about 9%. You're talking about 300%.
9% of GDP has to be somehow produced and taken. And I'm saying the figure's not nearly as big as 9%, because a lot of this is debt with interest payments which are just transferred.
But when you have this level of debt, you've got to service the debt. As well as paying the servicing, you've got to also pay the debt down.
Yes.
Okay.
Yeah.
And if you, again, I want to argue for looking through time rather than just a slice of time. And probably the best way I can do that is show you some correlations. Because if you're right, if it's the net level that actually matters, and you can net most of this out, so it's not a problem.
I'm not saying you net all of it. I'm saying you can net a good deal of it.
Well, I don't think you should net any, because I think gross debt matters on its own right, because you have to service your debt before you do anything else. If you don't pay your debt, that is an absolute charge on your assets.
But the major problem in the US is that many people with assets are frightened that the people who have the corresponding debt are going to disappear.
Yeah, but that's not what's causing the freezing. It's what's causing the slump is the reduction in debt, and I can show that empirically. So if I can quickly do that.
But can I just say, is that an asymmetry that the people who are highly geared and have high debts cut back on their expenditure? The people who own the corresponding assets do not increase their expenditure. That's a fairly straightforward story.
But it's not just distribution. If it was only distribution, I couldn't find correlations between change in aggregate debt levels and output, and I want to show you that I can. So my argument is that you have to look through time, not just a slice of time. And therefore, spending is going to be income plus change in debt, and you're then going to expend that on both goods and services and purchasing assets. Then the second stage of the argument say that therefore, if you're looking at change in aggregate demand over time, there's going to be change in income plus the acceleration of debt. And that'll be correlated to a change in economic activity, prices, levels and employment changing and so on, but also change in asset prices. So I'm working straight from the gross data. And if I do that, just to give you an idea of the scale I'm talking about, this is looking, regarding aggregate demand as being GDP plus the change in debt, stepping outside our usual definition. So the red line is America's GDP alone. The blue line is GDP plus the change in debt. And you can see the gap there, at the peak reached $4 trillion. So the change in debt added $4 trillion onto a $14 trillion economy. Then when when the drastic slowdown came and people were reducing their debt, particularly the finance sector, that at that point the reduction in debt was reducing aggregate demand by about $1.5 trillion. So you had a virtually $6 trillion turnaround in roughly $18 trillion worth of demand. That is what caused the crisis. It's the change in debt. Focusing upon balance at this particular point in time obscures this. Okay, when I showed that's one level of looking at it. This is showing the government's impact, the government borrowing added on top. I see the two as being additive. So change in government debt can be added to change in private debt to talk about the total amount of money in circulation. And you can see that the government's rescue clearly reduced the bottom drastically, and now when you add on what government spending is, debt finance spending on top of total spending by the private sector, it's actually boosting aggregate demand above that base level of GDP alone right now, but far less than they would be thinking, because again they're ignoring the level of private debt as well. This is looking at the correlation between the change in debt and the level of unemployment. Now, I don't know that I've done the R squared for that. I'll just do it quickly here. Hang on, that must be, let's see. Never do these things live because I know that's not the, let's see. I've got the right variables there. No, I thought not. It was far too low a level. Let's change the names.
You expect that to be somewhat lagged.
Pardon?
You would expect that the relationship to be somewhat lagged.
Somewhat lagged, but even without lagging, it's minus 0.92. Okay, but that's emphatic enough. But the one that blew me away, because I didn't expect it, I held off on trying to look at this correlation because I didn't think it would actually turn up in the data. I just didn't think the economic data would support it. This is now looking at the relationship between the acceleration of debt and the change in asset prices in America, and that correlation is 0.8. That's showing acceleration of debt drives asset prices. Now, I've moved 2 steps away from my initial argument. I'm still finding overwhelming correlations like that. Note that over a 20-year period, from 1990 right through boom and boom again, and bust again in house prices. So it is a very powerful argument, and that's why I say I'm not just arguing it hypothetically. I'm finding empirical support for it as well. We have to look at the change in debt. We've got to look through time, not across time, to understand what's going on there.
More questions?
Yeah.
A question on your model, complete growth.
Yeah.
And that seems to be dependent on after the sort of the recovery, the debt levels reset slightly higher.
Yeah.
Any empirical?
Yeah, well that's, again, the American data, because there's so much Ponzi borrowing going on and lending to households and so on, you don't quite see it in the aggregate data. If you take a look at this graph, you can see a couple of little cycles, like little, I mean they're enormous, but they're overwhelmingly based on an exponential trend. That, by the way, is what made me say there's got to be a crisis coming, because I saw that exponential trend at 2005 and I thought, holy hell, that has to break down. When it does, it'll be, good night economy. That's why I came out making the warnings. But you can see a little bump here and a big one there, and this huge addition on top. There's some sort of cyclical behaviour. But this behaviour that I was talking about really was about how the firm sector behaves alone. And if you disaggregate this and look at, I just find where I've got that done here, pardon me flipping through so many slides, that's looking at the debt levels by sector. And the one that's clearly, you can now see the cyclical trends quite clearly, the business behaviour. So those are the cycles of the private sector's borrowing for genuine investment reasons, cycling over time and ratcheting up, as Minsky argued. But we've overlaid on top of that, and this is where I think the crisis is so enormous, there's enormous growth in the shadow banking sector. That's the financial sector's borrowing from the banks themselves. And that's what's given us this total Ponzi breakdown. Again, going back to the 1920s, I had data going back to then disaggregated as well. And the aggregate level of debt was much lower in the Great Depression than now. But the difference was the business sector at that stage had a debt level up here. So when the crisis hit, it was the businesses that were in debt and had the servicing crisis. So their response to that was to cut their prices to try to get customers in through their door rather than the other door, when they'd both done the same thing. So they actually reduced the cash flows, they paid their debts down a bit, but the economy fell far faster through deflation. So that's why we had huge deflation hit back in the 1930s. Not much deflation now, though some. The difference this time around is that households are much more in debt than they were back then. So household debt here, about 25% of GDP, that was about the level it was at the Great Depression as well. This time around, household debt hit 100% of GDP. And the finance sector made up the rest back in the Great Depression. It was a matter of 10 or 15%. So it's the same qualitative overall crisis of debt deflation, but the difference this being because it's actually the customers who are debt encumbered rather than the sellers. You don't have the same immediate drastic pressure on prices to cause deflation, but it's still there, and this is why you have such low aggregate demand right now. That answer your question? Yeah.
Just when people ask questions, if you can just sort of say who you are and what you do, it might be interesting for Steve to sort of know
Yeah.
if you're an economist or whether you're.
Yeah.
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 Sorry, were you
They're just pointing at you.
I'll come next.
my name's Graham Cutchin. Economist at largely retired now, but in common with several people in the room, used to work with the late Win Dodley.
Yes, yeah.
I really want to ask you a question about the interface between your work
And Win's.
and the great Dodley of monetary economics.
Yeah.
And so, Ken, in his introduction, pointed out the list you had of the dozen or so people who forecast. But you were kind enough to note in your book that only two of those were actually modelers, and it was really only yourself and him.
That's right, which is, that's the amazing thing. There only were two modelers in the list, people like Robert Schiller. I mean, Robert's great gut intuition. It's no way he reaches results using neoclassical theories. It's a gut sensibility. Peter Schiff from an Austrian point of view, but totally verbal. So only myself and Win.
Can I just go on one step beyond that? I mean, Win, I think would have had great sympathy, a very similar outlook to everything you said. And in monetary economics, modelled this in a stock flow accounting, kind of double entry bookkeeping, as you call it, and derives everything
from that.
From that. So there seems a great parallel in what's going on here, but there's very little reference in your book to
Win's work.
To that work. Is that just because you've sort of been working along your own?
Well, I think because I've intersected with Win, we actually met and discussed. We have been about a couple of months together in the Levy Institute about 6-8 years ago. I have great respect for Win's work, and that's why I call my table the Godly Table. But we had a few arguments over the nature of the modelling, and there's a couple of simple ones. Win's work is in discrete time. And I've always argued if you're going to do economic modelling, you've got to work in continuous time, because even though our data is discrete, the economic processes we're modelling are not, and they're asynchronous. Each investment is discrete, but they're all happening at different times, different levels, different rates of repayment. What you get out of that when you put it all together is a smoother process, a bit like population growth. We don't model human population discretely because babies aren't born all on the same day. We model red crab populations that way because they are all born on the same day, or swan on the same day. So continuous time is a better framework. That's one difference we had. And he actually, when I was staying at the institute, I explained the Goodwin model to him, and he then built the Goodwin model in that simulation, that DOS simulation program of his. It was quite a remarkable job because he had to actually break it down to units of time, not being years now, but fractions of a year and so on. So we certainly met on very common ground on that front. He had the argument that in his system, all the columns and rows sum to zero because the flow has to go somewhere and end up somewhere. I always felt a bit uneasy about it. I couldn't quite explain why I felt uneasy with Win at the time, but my argument, ultimately I got an explanation for it years after that period, and that is that not everything in capitalism is a flow. When you have endogenous creation of money, you're making book entries. They're accounting entries into the system. So when you say, when a bank says to a capitalist, that's a great idea, here's $1 million, by the way, you owe us $1 million. That's two simultaneous positive entries that are not flows. So that's one reason that I wanted to have, that I now understand why I differed with Win on that. The other relates to economic modelling concepts. if you have something where you say everything sums to zero, what you're expressing is a conservation law, something's being conserved. That works at modelling the atmosphere. So when you look at meteorological models, they assume, with very, very good grounds, that the volume of the atmosphere doesn't change. They actually do allow for a bit of cosmic dust to fall and so on. They're pretty much saying it's a fixed amount of atmosphere, and therefore what you've got to call the dynamics of conservative systems, which, if you know your chaos theory, are quite different to another class called dissipative systems. And dissipative systems only differ from conservative ones in that nothing is being conserved. So if you model animal populations on the Serengeti, for example, you don't argue that the total mass of animals is remaining constant. It'll vary. And populations can grow and fall and so on. There's nothing actually being conserved. I think that's far more accurate of capitalism. It's not a conservation system, it's a distributive system. So forcing that everything sums to zero actually makes it into a conservative system, which is a fallacy. Another difference I had with Wim. But apart from that, very much shared methodologies, and I'm sure the fact that he was using the SAM tab, which I wasn't quite happy with, but was nonetheless, I'm sure that's why I got, one of the reasons I got the idea for that table. So I thought, when Wim died so recently, I thought, well, I'll call it Goldie table. Definite respect for his work, and his, one of the areas that I differ with people who follow on from Wim's work, and I think not done a particularly good job of it, is that they've stuck with this conservation law without being aware of it. There's a group called modern monetary theorists. I'm sure you've got Randy Ray, Bill Mitchell, Warren Mosler. They argue that the government sector deficit is private sector saving. That's a conservation law. And that's ignoring, that they're looking at government money creation potential, but they're not looking at private money creation potential. When you have to look at both of them and say you can have the private sector can spend by out of income plus changing its debt level, then you've got a non-conservation system applying there. The government also can spend out of taxation or by increasing its own debt to its central bank. So you get two debt terms, and they can go in opposite directions or the same direction with each other. You don't get the necessity for locking one up, the other down, which comes out of that thinking. Wynne used a framework like that to argue that the Goldilocks is doomed, a classic paper. He was applying that sort of logic. It's still generally true that if the government sector runs a deficit, then the private sector is more likely to run a surplus and vice versa. So I think he made a correct deduction, but it was too ironclad, and that has become part of the ideology in effect that private sector's deficit is government surplus and vice versa. And I think that's just again pushing a conservation law where there isn't one. So those are my overall positions with Wynne. Certainly when I write up my large-scale treatise, which this is not, then I'll definitely be talking a lot about Wynne's work and both the positives and the negatives there.
Can I just ask one quick supplementary?
Yeah.
I think Lance Taylor made a similar point on the difference between doing this in discrete time and continuous time. I think in Lance's case, he just said, look, I've been doing continuous time all my life. I just don't like doing it this way, so I'll translate it all into differential equations. So are you saying more than that? Do you get any of the results change fundamentally by?
You get, again, in terms of chaotic dynamics, you get a very different outcome out of a different equation systems for a continuous time. But the main problem with you're working in discrete time is that you actually build your time relations into the structure of the model. So if I say investment now depends upon the change in income of the previous 2 years, which is the Hicks equation, and I've got T minus 1 and T minus 2 in the structure of the model. If I in fact find that investment depends upon changes in output of the previous 3 years, I've got to go and rewrite the entire model. And nobody ever does that. They always have T minus 1 is about as far as they tend to go, and certainly a lot of people working in the SAM approach and a lot of neoclassical models as well simply have everything being lagged by 1 year, including consumption, which is just ridiculous. And Wynne's own work at one point, I think page 79 of the Wynne, Godley and LaVoy book, I think he makes a note that to avoid spurious dynamics, he had to lag something by an extra year. Because when you work in T and T minus 1 and so on, you can get to the stage where you have a variable depending upon something happening at the same time, which you can't simulate. You get an algebraic loop. So you've then got to add an extra lag in there to force it to be able to be simulable. That's just, that's false. So with continuous time, you can simply say, I've got a time lag. So for example, this model here, I've got prices being set with a 1 year time lag. But if you make it into a 3 month time lag, all I've got to do is change one scalar. So I won't illustrate it now, but it's very, very easy to do. So, and you can also make those variable through the system. So the dynamics I've shown you have time lags for lending going from very short when profit's high to very long when profit's low. It's just a variable in the system. So it's much, much better to work in continuous time than discrete time. Yeah.
Well, you seem to have satisfied or at least silenced our model builders. I wonder if we could turn for a moment to any policy indications you think you might offer on the basis of your instinctive really if you were, particularly on the level of debt, when to print and when to restructure.
When print, when to restructure?
Restructure,
yeah. I think we have to print on a fairly large scale and print and give the money to the debtors rather than to the creditors.
Okay.
That's very much there. I mean, I was interviewed with BBC Hard Talk on yesterday. Anybody watch the show?
Yeah.
Believe me, they call it Hard Talk for a reason. It's a bit like being involved in a jousting competition, and they make the first thrust. So
This is the BBC World Service.
World Service will be on a Monday night, and I suggested something that I dare not raise any outside my blog in Australia. I floated in Ireland. They got taken seriously, which surprised the hell out of me. I think it's too early for England, but the idea of what I call a modern jubilee, because we have to reduce the debt burden, the private debt burden. It's fundamentally the most important thing to do. But if we rely upon the normal mechanisms of capitalism to do that, it will take 20 years, as the Japanese have shown us. And if the government will continue pumping up its own debt level, balancing out this deleveraging process, often without knowing that's happening, it will take 2 decades. So we have to find a way of reducing the private debt level now. But because back in the 1930s, we would have done that by simply shutting the banks down, bank holiday, reorganising the books, opening again later with debt burdens drastically reduced. I have not read the history, but I think that is the large part of what happened during the bank holiday in 1933.
And in Sweden in 1992-93 as well.
But
in Sweden in 1992-93 as well.
Okay. That would work when we didn't have securitised debt. But because they have securitised debt now, there's many, many people, individuals and pension funds and so on, that have purchased debt instruments from the banks and rely upon the cash flow from that for their retirement. So if you did a debt jubilee, which abolished large parts of the debt, you then put people who are currently legitimately expecting to have a cash flow in bankruptcy. So you really have to unscramble an egg now. It's much more complicated than it was back then. So one way to do that would be to give money to the public in general, but give it in such a way that if you had debt, the first thing you had to do with that money is pay the debt down. You could not spend it. Wouldn't be done to direct consumption. We would specifically pay your debt down. But on the other hand, if you didn't have debt, you'd get a cash injection. Now, what that would mean is people in debt would have to pay the debt down. Banks and institutions that hold the debt would not have any change in the value of their assets. The loans would fall, their cash reserves would rise. But of course, it's the loans that determine their income earning capacity. So the income earning capacity they would have, and then also the instruments they've sold, would decline radically. Now the banks themselves might therefore need reorganisation, but not as much as if you outright abolish debt. The people who bought those instruments, the pension funds and so on, would have much less cash flow coming through because the value and the cash flow from those debts would diminish necessarily, given the policy. But they'd have cash reserves out of which they could spend. So you'd minimise the disruption, but it involves a dramatic shift from a credit-based system to a fiat-based system in terms of the current proportions of money. Because at the moment we've massively got a credit-based money system with debt attached to it, a very small amount of fiat money which is being bumped up, poured in the wrong reservoir, poured into the bank's reserve accounts rather than put to the people who could actually pay their debt down with it. So that's a huge policy proposal.
Isn't that what's happening in the UK at least? Everyone's reducing debt, including the banks, as fast as they can.
They're reducing as fast as they can, but by doing so they're destroying aggregate demand. But to do that,
Of course.
yeah.
So what do you recommend to get over that?
Well, if you did something like this modern jubilee, what you would do is you would not reduce the spending power. You reduce the debt to be an absolute fall in debt as soon as the policy is put into place. So you wouldn't be a deleveraging process reducing aggregate demand. You'd then reduce the debt burden on people who are in debt and currently can't spend. So you'd actually free up more consumption by people who are currently debtors, which is the vast majority of households. And at the same time, you provide spending power still out of the cash reserves that people who were not debtors would get. So you'd have two positives for aggregate demand.
So how do you make them spend when they're in?
Pardon? How do you make them
spend?
Well, you don't have to make them spend. Once they've got the money, I think the money without the debt. What's stopping them spending right now is the debt servicing has to come first. If you don't pay your debts, you're bankrupt. So that is an essential reason not to go shopping. But if those debts have been reduced by this mechanism, then you've suddenly got much less debt burden. If you've got an income flow, less of it has to go to debt servicing so you can afford to spend. And those that had no debt but assets, financial assets, have less cash flow, so they're encumbered by that, but they have this cash injection.
So you
They
agree
can spend
with,
out of the cash injection.
you agree with the banks currently giving priority to reducing their debt?
I think we have to reduce debt, but I don't give priority how they're doing it, because if we do it in the usual mechanisms of capitalism, bankruptcy and people paying the debt down slowly, that means about 20 years of declining aggregate demand. Just to give you an idea of the scale of it, I've taken, pardon me, I've got to page through a few slides here. Oh, here we go. This is looking at the historical experience from the Great Depression and saying that if you look from the actual peak at the debt level, the rate of reduction was 12.5% per annum to get to 1945. This is more sensible because that was caused by deflation, so I think that's a better one to take. And that still argues for a 9% rate of reduction of debt through that whole period. The reduction in debt itself causing aggregate demand to be low for all that period. If we start from where we are now and reduce the rate we're currently doing, and that's currently working at 7.9% per annum, then it would take us 20 years to get back to the 1960s level of debt.
So how do we get competition going again?
Well, I think capitalism generates competition innately, but you've got to get rid of the Ponzi merchants. To me, that's the real danger in capitalism's danger isn't the capitalists or the workers, it's the Ponzi merchants. And we fall from there every time because banks make money by creating debt. Okay? And they've got an incentive to create more debt, and we fall for it when there's an asset price bubble going on. What actually happens is the lending itself causes the asset price bubble. That's why I was delighted, horrified and delighted to find that correlation, because it really says what causes rising asset prices is accelerating debt. So you've got a positive feedback loop between rising prices and accelerating debt, which then causes the bubble, gives you a huge debt burden and causes capitalism to collapse. But if we didn't have that Ponzi behaviour, capitalism would be cyclical, as Schumpeter argued.
So we abolish the banks?
No, I'm not in favour of abolishing banks. There are some reformers, like the American Monetary Institute, for example. They want to bring in full reserve banking, and they want to have the government being the only body for money creation. I don't argue against it because it would feasibly work, but the trouble is that two things about it. First, we're relying upon the government to get it right. I'm nothing for cynic about the government not to believe that will happen. Secondly, the banks would be, you still have to have banking institutions doing the lending and holding reserves and so on. The banking would still exist. You can't eliminate banks. Even if you constrain them like that, you can't eliminate them. Well, they're going to be sitting there plotting, waiting for a crisis, knowing the government's going to cause one. Maybe they contribute itself to cause it as well. I would never cause a bank for a fraud because they could sue me. Could it happen? There would be a breakdown. And the bank would say, look how bad the system is. It was much better when we ran it. Let's go back there again. And I could see us evolving back to it again. So I don't think, and it's also, I think, attacking the wrong end of the system because it isn't banking per se that's at fault. It isn't the fact that private banks exist and create money. It's they create money for speculation rather than investment.
But that's the whole purpose. That's the whole. Let me just mention it.
Yeah.
The whole point of full reserve banking is to prevent banks from creating money for the purpose of speculation, and it's almost the only way to do that, one could argue. I mean, there may be other ways to do it, and I asked you that earlier today, and so how are you going to prevent banks from creating money for the purpose of speculation? And my argument is that as long as they can loan money into existence, rather than allocate money that's already in existence on behalf of people who entrusted them with that, and we're going to watch that very carefully what the banks do. As long as they can loan money into existence at their discretion, there are going to be borrowers out there colluding with bankers out there to disguise what's really going on, i.e. asset speculation. And so I actually, I haven't thought this fully through yet, but my inclination is to suspect that the full reserve banking people got it right. And I also would mention that the idea about the government getting it wrong, you can't get it much more wrong than creating money for purposes of asset price speculation. You can't get it much more wrong. And I can easily think of ways to have sort of citizen-controlled determinatory mechanisms for allocation of fiat money created, at a moderate pace, decided on the Monetary Policy Committee of the Central Bank, 3% of GDP per annum or something like that. I can easily think of ways to regionalize and distribute that process to town councils, et cetera, et cetera, et cetera, with democratic accountability built in to prevent very much of that money from getting spent on insane, crazy things that some minister decides to do in order to pay off his friends. So, if you look at it a little bit more carefully, put it this way: I don't think you should reject.
I know, I'm not
I don't think you're
rejecting
rejecting on the grounds that you suggested.
Well, my reason, having spoken with the American Monetary Institute people, I said, well, I disagree with you on one point. Their control system alone won't stop asset price speculation. We can still lend money to gamble on house prices. It'd happen in that system anyway, unless you make it not possible or not feasible to make money out of leverage speculation on asset prices. So, and they've agreed with me, and they've actually changed their legislation a bit to say, put a couple of ideas that I've put forward as well. And my problem really isn't private money creation by banks. It's that's then used to finance asset speculation. I think private money creation, banks, I'd rather have a bank, not the current one obviously, but banks of 40 and 50 years ago, making decisions about which companies to lend money to, than I would like to have governments doing the same thing. So can I just give the scheme? I've put two proposals forward addressing the speculative side of things, and that is what I call Jubilee shares, and it would redefine shares so that shares exist as they do now if you buy them off the company, no change. But when you sell a share to a speculator, another share buyer, it lasts 50 years and it expires. The idea being that it would be very, very silly of anybody, not just being a greater fool but a greater moron, to borrow money to buy a share off another speculator. Because it's only got a 50-year lifespan, its terminal value is zero. But if you buy it, of course, you get an annuity for 50 years, which is a substantial period of time. You would actually do the sort of net present value calculation we currently con our students into believing they actually do right now to set share values. So that would hopefully mean far less gambling on shares and reduce the size of the secondary market and increase the primary market. And the second proposal is what I call the PIL, property income limited leverage. And that would be, at the moment, banks pretend that they lend on the basis of an income, because back in the 60s, they give you a loan to valuation ratio of say 70%, and base the repayments on your income level. But if you're competing with somebody else for the same house, that gives you a motivation to want to have a high level of leverage. You're in the same income, then they can beat them to borrow more money. So you get a positive feedback, and the public has an interest in that initially, which sets off the chain reaction. I would rather limit the amount of leverage that banks can secure against property to some multiple of the income of the property, whether actual or imputed. So my ratio is say 10 times, and that would mean that if you had two people like myself and George Soros competing to buy a property that generated £225,000 of rental income a year, both he and I could only get £250,000 of the loan. Therefore, if he wanted to beat me, he'd have to put more of his own money in. You get a negative feedback between house prices and leverage. So those are fairly simple changes in how we define capital assets. Rather than
you would have to apply that to all assets.
Yeah.
There's lots of cheap money floating around.
You would.
I just want to allow time maybe for about one more question, because I want to bring to a close by 5:30. So if there's anyone who would like an opportunity, please.
I just had a question about banking capital reserving.
Banking
capital reserving calculations.
Yeah.
At the moment that's based on VAR, which obviously can be used in basic history, but
Yeah.
I'm seeing new versions coming out, sort of bubble VAR and something called hybrid VAR, which seem to want to adjust the cyclical behaviour. Is that something that you think would be...
No, I don't, because to start regulated. If you're talking government making money control decisions, and you hypothesise mechanisms like JASCA just did to control it and make it responsible and so on. But you give a regulator the role of manipulating in the opposite direction, they'll be overwhelmed by the banks. If you just imagine, if the old pressure is taking the punch bowl away, if we saw the regulators actually, they chop the punch up with some extra vodka. That's what they really do, they get captured. So you can't rely upon that anyway. And secondly, when you look at the money mechanisms starting from endogenous money, reserves aren't a control mechanism anyway. I really recommend reading Holmes' paper. He really goes through in quite deep detail as to why reserves aren't a control mechanism. Part of it being that the reserves are required, this was back in '69, it's really not much different now, I would imagine. The reserves are based on the deposit levels 2 weeks earlier. So the loans by that stage have created reserves in the system anyway. And then if the central bank doesn't provide the reserve, the system freezes. So again, they don't have the discretion. We believe they have in our simple textbook models of the money multiplier. And then finally, if you look at the actual reserve requirements in America, they now run to about 3% of the total money supply. The maximum level of is 10%. That's only against household deposits. There's no reserve. There has been no reserve requirement on corporate deposits or money from Eurobank loans for 10 to 15 years. So there's actually, if you like, an infinite money multiplier there. Now, why is that? I think really the role of the money multiplier or the reserve requirement is to make sure that banks have got about 10% of their loans, 10% of what they need for depositors, household depositors on hand in case there's a run. That's really the role. It's there as a backstop. It's not a control mechanism at all. And just recently, a couple of Federal Reserve researchers have published a paper called "Does the Money Multiplier Exist?" So they're finally admitting even in the bastions of the reserve that it doesn't. So it certainly is not a reserve firm, a control mechanism.
Okay, I think we'd better bring the meeting to a halt at that point. We've had a tour de force from Steve in his explanation and his mastery of really how to think about the process of debt creation and spending, and what a powerful dynamic it can be in terms of explaining cycles and crises. So we thank you, Steve, for being able to fit us in to your very hectic
Well, delighted to be invited. Thank you very much.
Anyone who doesn't have to immediately rush off, please do help yourself to some refreshments. And,
You'll be happy to hear, as of yesterday,
Pardon?
you'll be happy to hear, as of yesterday, new version.
New
Version back.
Oh no. Virgin. As in Renard's
I'll kill Alison first.